name is Tom Gaynor. It's my pleasure to welcome you to the 2019 Markel Brunch. We're so glad that you're here. I'm joined today by my co-CEO, Richie Witt, and our CFO, Jeremy Noble, and I'll turn it over to them in just a minute, and then we'll start taking your questions. But first and foremost, I know many of you have been here in prior years. Some of you are here for the first time. I apologize for the repetition for those of you who have been here a number of years, but there's a liturgy and an incantation that makes sense to go through. So we could not do what we do at Markel without the right sort of owners of our business, to have a long-term way of thinking, to have a long-term way of running the business, and not be caught up in the short-term way of doing things requires an ownership group that's all on the same page and thinking about the long-term health of the business. And this gathering and what it has come to represent, and your interest, your support, your ownership of Markel has been critical for us to be able to do what we've done, and it'll be critical going forward. The history of this gathering is that back in 1990, when I joined Markel, Steve Markel, who hired me, we talked about a number of things and the vision for the company, and one of the things that I said is that the people who are most likely to understand what we're trying to do are people who already own Berkshire. So rather than trying to get them to come to Richmond, let's you and I go to Omaha. And I said that in 1990. The first year we had 6 people come, and we drank coffee and ate bagels, and we just said, if you know anybody else who would like to come next year, let them know, and we'll be back next year, and just take it from there. And that's what has happened year by year, and more people every year. And I'm judging by the count of people here in the room, I think it's still true that there are more investors in Omaha than there are in Richmond. So we're glad to meet you halfway. I know people come here from all over the world. You also are welcome in Richmond. Our annual meeting is next Monday, May 13th, and we do have a growing number of people that are coming to that meeting, but it doesn't touch what happens here yet at this point. So thanks for coming. Before I open them up for Richie and Jeremy, I do want to thank the Markel colleagues who also have made the trip, and let me introduce them to you. I think everybody's up here that I have on my list.
I'm over here too.
And oh, great, good stuff. Yes, Joanna Bergeron with CapTech up here. Bob Cox on the Markel on the insurance side. Nora Crouch, our Chief Accounting Officer. Andrew Crowley, who works with me on Markel Ventures and incredibly helpful in so many ways. Ross DeBolt, who is the COO of Parkland Ventures. April Duff is the treasurer of Markel. And let me pause. I'm doing this in alphabetical order, and some people, as they say in Animal Farm, are more equal than others. And let me introduce the one who is most equal this weekend, and I hope she is in the room to hear this at this point. She probably is out there working and herding people in, and that's Georgie Engels, who primarily works for Richie, but also helps me and Jeremy and really all of us. Georgie runs the show to put this together and handle all the logistics that happen in an event like this, and she's done so selflessly. It's the complete Markel style in action. It's not her actual birthday today, but sometimes this meeting falls on her actual birthday, just the way the calendars work, and she has been here consistently with us no matter what. And if you could just take a moment to thank her for her work. We have Matt Freeman from State National, who's with us here. Henry Gardner from Markel International. Susan Gaynor, who's the CEO of Parkland Ventures, which is a Markel Ventures company. Dan Gertner, who works with me on the equity and investment side. Josh Goldschmidt, who runs our Eagle Construction business. He's around here somewhere. He's been up there. He is, being very modest. Richard Grinnan, our general counsel, right there. Matt Hannay, who works on our fixed income operations.
7th today.
And
Matt Hannay finished 7th in the race.
Matt Hannay finished 7th in the race today. As Tony Markel says, one of the secrets to success in business is hiring people who are smarter than you are, and that's the challenge. The bad news is how easy that is to do. But being a very amateur runner, Matt is indeed a serious runner. So he's one of those people that's better at things than I am, that's part of the organization. Mike Heaton, who is the president of Markel Ventures and my right-hand deputy on running the Markel Ventures operation. He's been side by side through the entire journey of building out that entity from an idea to a $2 billion business. So thank Mike. Steve Holdyke with CapTech is here. It's his first visit for this gathering. Matt Hewells, who runs some of our specialty insurance operations here in Omaha, among other things. Beth Hungate-Nolan, who joined us from a local law firm in Richmond and part of Markel Ventures. Dan Kennedy on the sales side, with the insurance side here in Omaha. Terry Ledbetter from State National here with us today. Diane Leopold is one of our directors who joined us. She might be in the audience. She's a director, so she doesn't have to stand up here if she doesn't want to. But we appreciate her taking the time and making the journey to visit us. She has an important day job with Dominion Resources, which is the leading utility in Virginia. So volunteer effort, she's coming here. Sarah Madan, who I think more of you know than know me, has joined us and been here a little over a year. Works with me on the investing side. Shannon Martin, who works again with Georgie and Richie and Jeremy, and is working with Georgie to make everything happen here this weekend. Carla Owens, running our digital efforts over there. Mike Parsley in facilities. Chris Reichert, who does sales and sales efforts out at Omaha and Richmond. Robin Russo, who is our Chief Underwriting Officer. Barney Schauble from Nephila is here with us, one of the co-founders of that organization. Linda Schreiner, who is our Chief Administrative Officer. Ben Sumter, who's the CEO of the Ellicott Dredge Company. Tim Tompkins, who runs sales and marketing efforts for Markel in the insurance business. Dave Watkins, who runs the accounting side of Markel Ventures. Rob Witt, who works with Richie on a lot of M&A activities and integration. And one of my favorites, saving the best for last here, and there was one story that demonstrates things, is Frederick Wolf. And for Frederick, so the story I want to tell about Frederick is that Frederick runs our German operations, and it's gone extraordinarily well. And in the wake of Brexit and some of the things we've done, his role and his importance to the Markel organization continues to grow. And whenever you hire someone, you don't exactly know what you're going to get, and it takes a little while to build up time and grade and understand things. But I will tell you one story about Frederick that gave me personally immense confidence that we had done the right thing with joining with Frederick, and that is that the deal happened, and it was very close to the date of the Berkshire gathering. So I had never met Frederick, and the deal had just been done. We had not had the chance to meet at this point, but Berkshire weekend happens, and this gentleman comes up and introduces himself to me, and it was Frederick. He had come of his own volition, on his own nickel, to be here at the Berkshire meeting, and that is about as big a tell as exists on planet Earth. So, Frederick, thank you once again for coming, and I hope we're paying for Frederick's expenses at this point. That's the gang. There might be other people who are associated with Markel in some form or fashion that's here that I don't know about. If so, please raise your hand. I tried to be as comprehensive as possible, and I don't see anybody, so amazingly enough, I may have gotten everybody. So thanks very much. Let me turn it over to Richie to say a word or two, and then Jeremy, whatever he'd like to say, and then it's going to be questions. We'll line up the mics 1, 2, and 3. We do ask Mr. Jeff Stacy to sort of work your way up there, because we're going to give him the first question just to break the ice and get things going. But Richie?
Yeah, well, just let me add my welcome and thank you again for coming and joining us on Sunday morning. This looks every bit as full as the room was last year, so great to have so many people coming to and allowing us to tell you about Markel. We are off to a really solid start this year, so we've got obviously a lot of things that we've added to the platform, and so I'll just say looking forward to spending the next couple hours with you, hopefully taking some questions and giving you some insight into the platform we're building here at Markel.
Thanks. Jeremy?
Yeah, good morning as well. Thanks for being here. Thanks for your support and your interest. We love the opportunity to talk about the story behind Markel. So I think without further ado, let's start doing just that. Thank you.
Thank you. All right, well, I would like to introduce, I don't know what this question is going to be. For a long time, we've had a tradition of asking somebody to ask the first question just to get things rolling. And Jeff happened to be having dinner with me at a moment when I needed somebody to do that. So he has stepped up, and this will be his second year of the first question. So,
Well, Tom, thank you. Just a big thank you to Richie and Jeremy and you and all the Markel colleagues for hosting this event. I wasn't part of the Sainted Six at the first brunch, but I think, and my memory's a little fuzzy here, I think I was at number 2 and there was 12 people, and I'm not very good at estimating numbers, but I'm comfortable in saying there's more than 12 here today. So thank you for creating such a wonderful forum for us all to ask questions and to learn more about the company. So my question is this. At last year's brunch, you talked and compared Danaher and Berkshire Hathaway, and you know, in conventional terms, you described Danaher as a centralized management approach, and of course, Berkshire Hathaway is identified as a decentralized management approach. But the important point I thought that you made last year was that it's a mistake to think of those approaches as static states or fixed points, and that it was really more of an evolving continuum based on circumstances.
So one of my great business teachers, and this isn't secret, these are not secret lessons. You can have access to the same guru that I study, and I study him every single day. Not a day goes by that I do not consult this business guru, and that guru is Dilbert. So he's open and available to you. And I can't remember whether one of this week's lessons, it might have been Wednesday or Thursday, I'm not sure which day it was, but it was this preceding week. So there's Dilbert and Wally, and the pointy-headed boss and whatnot. And the pointy-headed boss announces this reorganization where we're going to go from a decentralized model to a centralized model and reorganize everything. And Dilbert points out that didn't we go from a centralized model to a decentralized model last year and have to reorganize everything at that point? And the boss said, yeah, and the intern or something like that said, why don't we just not do it and save all the money of the reorganization, because we're just going to go back the other way. The comics conveyed it better than I did, but you get the sense of things. And I think what Dilbert is putting his finger on correctly, as he often does, is the notion that there is an ongoing balance between what you should and should not centralize. And the things that are closest to the customer and whatever wellspring of entrepreneurialism you want, and that agility and nimble kind of stuff, you want that as decentralized as possible. And we have had a philosophy over a long period of time, and Berkshire is the same. And by the way, so does Danaher. They just describe it differently. They want people in the field and running operations who really do feel empowered and a sense of ownership and culture about their business. So our bias is that way, and it continues to be that way. To get excellent performance, you have to give people long leashes. People who are really good at what they do not like to be micromanaged. So that being said, we are a public company. We have public company financial statements. We have fiduciary duties. And there are certain aspects of command and control that go along with that. And every day is a matter of striking the balance between the two. I would expect that what you should expect from us in the future is to continue to make mistakes of commission, where we have delegated authority into the field.
You know, we will learn from the situations that we had in 2018, and we will rebalance as necessary. But I think we'll always try to err on the side of giving people that authority and autonomy, because that's where we've seen the best results come from.
Okay.
I think that's very well said. I won't add anything to that.
He gets the Charlie Munger
Yeah,
role this
that's
time.
right.
Yeah.
All
All right.
Nothing to add.
Thank you.
And tell us your name as your answer. Yes.
Taylor Finch from Austin,
Yes,
Texas.
absolutely. I wanted everybody else to know.
Thank you. Tom, thank you for putting this on every year. And I'm happy to see it's moved over to the Marriott in support of our holdings there. So they say when you know, and I never believed that until I met my wife. The first 3 dates I was on the fence, and the fourth date it hit me like a ton of bricks, and we've gone on to be very happy. So to bridge this over,
Is she here to verify this? We'll take you at your word.
I'll bring her to the Markel meeting next week. So to bridge this over, I wanted to ask you guys with the insurance-linked security market, what was that moment for you guys? Was it data you saw or a conversation you had? When did you guys realize that this was going to be a big opportunity for Markel?
Yeah, that's a great one. I think it was just as we were watching it grow and started meeting the people who were really, quite honestly, pioneering in the ILS space, and talking to them about why they were attracted to it, why were they trying to disrupt the industry in this way. And the thing that just hit me, I guess the thing that hit me like a ton of bricks was thinking about the fact, at least initially, ILS is focused on peak catastrophe risk, peak zone catastrophe risk. And that every insurance company that writes property has peak zone catastrophe risk. And the amount of capital in the insurance industry is something short of $1 trillion worldwide. And yet we were taking on these massive risk to catastrophe and keeping them on what is really quite only a drop in the bucket in terms of capital, in terms of the broader financial markets. So here we are, we're sort of taking a fairly correlated risk, keeping it on a relatively small capital base, when what makes sense is to spread that peak risk across the broader capital markets. And oh, by the way, that peak risk is non-correlating with the risk that most of the rest of the capital markets is taking. At that point, it just hit me. This just makes too much sense to not continue to grow. It is going to continue to grow because the math and the process around that just makes too much sense.
Yeah, I think that's a really good point that Richie raises there. It's really about sort of that way to transfer risk to capital and thinking about that a bit differently. We've learned a lot as an industry with regards to the last 2 years, unprecedented with regards to catastrophe, about the role that capital and ILS plays. But I'd also say that, Richie, I think really drew out some of our curiosity in the space and the thinking in the space. But it's back to we needed to identify businesses with operators that really would fit within our company. And that's where organizations like State National and Nephila that were really leaders in the space, very sort of fortunate to have the opportunity to have them join Markel. So we were able to match kind of curiosity with execution, and now that's a lot of what makes us so excited about where we can go off the back of kind of the last couple of years and thinking about what the space looks like. But I think it's really important for the greater kind of social purpose of insurance. We've got to find a way to manage that risk across a much broader capital base that sits within the insurance and reinsurance industry. I think that's the only way we're going to have better solutions in the insurance space.
Thanks. And the thing I would add to that, so you can't talk about anything in life, it seems, these days without addressing the role of technology and the pace of change that comes about from that. Well, I think one of the ways in which you can sort of do an acid test about whether this new technology is going to really take off or not is it's subject to the test. There's a three-part test of better, faster, and cheaper. And in the old days, pick whatever measurement you want to say old days, typically you could have 2 out of 3. If you had something that was better and faster, it wasn't cheaper. And you had something that was faster and cheaper, it wasn't better. But in the world we live in today, in almost any realm you can think of, things get better and they get faster and they get cheaper. And anything that is not able to pass those tests is at immense risk of not really working, and it's not really durable. So when we saw the insurance-linked securities mechanism begin to come into maturity, the conclusion that we all came to was that this is better, it's faster, and it's cheaper. And the thing that Richie didn't say, and it was at the basis of a lot of the conversations he and I had in the early days of this, and I stressed it in the annual report, this mechanism can be applied to a lot more than what it's being applied to right now. It is another trunk line railroad that goes between risks, however you want to define that, and pools of capital. and it's a different, that railroad line runs to a different place than the railroad line that runs to insurance company capital is. And we now have the leading mechanism in place that operates on that line. So it's a big market. There's lessons and tuition to be paid to learn how to do it, but I remain every bit as excited, if not more, about our efforts in that world. Thanks.
Excellent.
Sir.
Hi, my name is John Norwood. I'm a Markel shareholder from Des Moines, Iowa. Thank you.
Thanks for coming.
So I really like your summary table on the front page of the report. That's really helpful. I have two questions. One, is this a temporary slowdown, do you think, in terms of last year's performance? And then the second part of my question is the share price. Can you tell us a little bit about that higher share price? Do you think that's sort of in an optimal place, or do you foresee some kind of a share split at some point?
All right, let me try to address some of those. In terms of last year's performance, as I say, it was a fascinating year. We obviously, in the 3 steps forward, 2 steps back of life that you have, things don't happen in a straight line. And last year, in many ways, when you just look at reported numbers, was a step backwards in terms of learning, maturation, the skills being developed at the company. I actually think we made immense progress on a lot of fronts that might not have showed up in the 2018 numbers, but 2019, 2021, and beyond, I'm pretty confident that it will, and that's why we did the things that we did in 2018 to build that. And again, that's why this group and this audience, being Markel shareholders, is so critical for us, because we really do need some length of time to let things play out. So part one of the answer to your question. Secondly, in terms of what would happen in any given year, well, if there are enough given years that get strung together back to back to back that don't have good financial performance, it's been nice knowing you. But we might not be back here, and you might not want to see us. So fortunately, so far, in the context of the 29 years we've been doing this, there have been forward years and backward years, but the forward years have far outweighed the backward years, both in frequency and severity, as we would say in the insurance business. In terms of the share price, yes, we have not split the stock, and we have no intention or plan to do so. We wish to have people own the stock who feel like owners of the business. And so really you're becoming partners in our business and our enterprise. And the opposite of that is people who think of stocks as just electronic blips to be traded in and out all the time. So we think that by the ongoing building up the business, there's a share of it, there's a partnership interest in it, and not engaging in things that would facilitate or foment or amplify any short-term trading stuff. We continue to sift and sort and get a better pool of owners over time. So no splits. Anything?
Nothing to add.
All right. John Fox, would you tell us what your name is? You should come to the mic.
Yes. Let me think. John Fox from Fenimore Asset Management in upstate New York, and I'm here because Tom Gaynor asked me to ask a question.
Thank you for doing so.
You're welcome.
But I didn't say what question to ask.
Yeah.
He does not know the question, and I'm going to ask my question and sit down so I can write the illuminating answer. Tom and everyone, you've focused on book value per share growth over a 5-year period. Historically, your compensation is set by that, and total shareholder return, which I applaud, by the way. But Tom, you've said publicly, and I believe written, that due to the acquisitions and changes over the years, that book values become less of a meaningful measure. So could you talk to us about how you think about valuing Markel today? I mean, I see the insurance business, the Markel Ventures business, and then the 2 interesting things you're doing in insurance, which you call other, and talk about, how should we think about the value of Markel? I'm going to sit down to write down the answer. Thank you.
Okay, well, thank you. Thank you so much. It's an important topic. It's something that has been talked about in our own boardroom, and Richie and Jeremy and I have all talked about this over the last several years. So a couple of things. One, I was very grateful this year and thankful when I received the Berkshire annual report, and he started off with why book value does not comprehensively describe the progress at Berkshire these days. I've been saying that for a couple of years now, so it's nice to have my big brother Warren say it as well, because there's amazingly enough, there's a lot of people in life who pay more attention to what he says than what I say. So I'm very grateful that he said that. And I think his explanation and analysis for that is exactly right. Within the context of the Markel annual report, if you read the shareholders' letter, I'm pretty sure, I was the guy who wrote it, so I should know this for a fact, and I'm going to guess, and I'm sure I'll be fact-checked and proven wrong. But I don't think in the body of the letter I talked about book value at all. I talked about a lot of financial metrics, but I did not use that. So that omission in and of itself is, like the Sherlock Holmes dog that did not bark. So for financial businesses, and our insurance business is a financial business, and book value does do a good job of describing the classic insurance component of our business. But the change in Markel over the last 10 years and last 5 years at an accelerating pace is we have businesses other than insurance within our operation. Now, as an example, I think Taylor had mentioned we shifted from the Hilton to the Marriott, and he tipped the hat that we're Marriott shareholders. We have been for a long time. Well, he's exactly right. And if you look at the Marriott Corporation financial statement, what you'll see, and I don't know this for a fact in my head right now. I know it was true before the Starwood deal, and that introduces some accounting machinations. But I'm highly confident this was a true statement before the Starwood deal, and it will be increasingly true as time goes by for Marriott. The book value of Marriott is negative, and it's been declining. Well, good gracious, if you looked at a financial business and you saw the book value go down and you saw it go into negative territory and get more negative, the conclusion you would draw is they're broke. But they're not. They're doing great. And it's because that's a business that doesn't require much capital. And the way you should think about valuing Marriott is you should think about the cash flow being produced. And it does not require much capital to produce the cash flow they have. This facility that we have is probably owned by somebody other than Marriott. What Marriott has is the management contract, the reservation system, which requires very little capital. And what Marriott does with the cash that they generate, because they don't have to reinvest it in physical, tangible facilities, is they buy back stock. And when you buy back stock at a price that is higher than what your stated GAAP book value is, that makes the GAAP book value go down every single time you do that. And we're at the stage at Markel where we have a number of non-financial businesses, which to some degree are like what Marriott is. So it's an income statement business, something that produces cash flow and doesn't require much capital. And the way I would value that is I would make an estimate of what the cash flows are going to be, and I would apply a market multiple to it. And so I think that the stock market in the long run is pretty efficient, and it gets that. And over the last several years, the divergence between the market price of Markel and the book value has widened. I would suspect that would continue to be the case. And insurance-linked securities is somewhat of a hybrid because it has the word insurance in it, but the valuation mechanism is really more like the way you would think about our ventures business, i.e. a multiple of the cash flow. Now, to recognize that and make sure that we are aligned as managers of the business that you owned, we did make a change in our incentive compensation system this past year, where the first step was Richie and I, half of our compensation is now no longer based on just the 5-year compound growth in book value, but also the 5-year total shareholder return. So what you make as a shareholder, point to point over 5 years by owning the stock, is half of our compensation. And Jeremy joined the party in that, so we're a crawl, walk, run company in many ways. This was a heavy-duty boardroom discussion of making this particular change. So at first they made it for Richie and me. We included Jeremy, and I think it'll spread to people in the organization who are tied to things other than the insurance business. It would make sense to have a different mechanism than just book value. And then the last thing I'll say about this before offering the mic is well, how about this? And this speaks to the muddiness and the fact that you need to make judgments about things. So think about Progressive. which Buffett and Munger talked a lot about in the meeting yesterday. Progressive is an insurance company in every form and facet and way that you could possibly think about it. But Progressive has sold at a high multiple to its book value forever, for a long time. Well, why is that? Well, the old joke about Progressive is that it's a Mensa club masquerading as an insurance company. They're really smart. I mean, what they do is really worthy of study. They're very good at what they do. And as a consequence, really what you get when you're buying Progressive is not a commodity insurance company that would be well described and valued by the book value. What you're buying into is the intellectual capacity of the management of that business, which produces higher and higher cash flows as time goes by. So it's just a different way of thinking about it, and that is the way I think about Markel, as I break it down between what we're making in the insurance business, what we're making in the ventures business, what we're making in the other businesses, what we make in the investment business, and assign appropriate multiples to each of those, add it all up, subtract out the debt, and boom shakalaka, there's some estimates.
Yeah, Tom nailed it. The only thing I would say is I can remember back when very few, and probably still today, very few analysts follow or try to put a number on Berkshire. And it was because, from their standpoint, it was too hard. You couldn't just take book value and put a multiple against it and voila, you're done. We very proudly have tried to emulate a lot of the things that Berkshire has done. And as the businesses that can't be valued off of multiple of book, as they become a bigger and bigger piece of Markel, it requires kind of a sum of the parts analysis to really dig in and understand the value of Markel. And I know the people in this room are smart enough to do that. We'll have no issue putting that math together.
I think it's important enough that I'll add a few thoughts to that too. I think Tom and Richie really covered it, but it's also the case as we think about businesses moving forward, I think it's going to be quite common that you actually aspire to find businesses with intangibles. And so we do have this aspect of a significant portion of our balance sheet is held at fair value. That's really that historic insurance side. But these other businesses, these non-insurance businesses, they're not held at fair value. And all of a sudden, that is going to generate this decoupling to book value. And oddly enough, right, we record a lot of intangible assets, and we amortize those off, and we never get to write up the value of these beautiful businesses that we own. They're generating the cash flow that Tom references. So, hang in there, and we're going to continue to tell that story, and you'll see that in the financials. And I think this room is as Richie alluded to, intelligent enough to follow that story. It's baked in, embedded, I think, in the stock price. But I just think from an acquisition standpoint, you'll continue to see us aspire to look at businesses where the intangibles are really what drives the value proposition of those businesses.
So we have a fellow finisher from the race this morning. Were you seventh or better? It's okay. You
don't judge. Thank you for hosting this event. My name is Steven, and I'm from Singapore. Last year, you opened a new office in India. And Tom, you also paid a visit to India. So I would like to hear your view about the Indian insurance market, and more broadly, what do you think are the opportunities and challenges in Asia for Markel?
Thank you. Yes, with Saurabh Badan leading the way, I did go to India and spend 8 days in the country. Saurabh did a spectacular job of connecting me to a number of CEOs of leading companies in India. It was eye-opening and fascinating trip. India is the world's largest democracy. It is growing at breakneck pace. I think that will continue to be the case, and everything that you would logically conclude from that base set of facts would indicate growth, 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 growth in insurance as well as many other things. We do have a small, tiny presence. In fact, it's so small that between the time the trip was planned and the time that we actually got on the ground to visit the office, we actually doubled the number of employees in that office. We went from 1 to 2. So between the roughly 1.2 billion people that are in India, I think now that we have 2, there's room for more.
Yeah.
So we continue to do our diligence, do our work, write some insurance, and it's an epically big market. And it speaks to a larger point. We're celebrating, again, you've been here for 20-some years, something like that?
Close, 17.
17, okay. We're rounding up.
I'm working on it.
And we're rounding up. And Richie and I, we're going to round up to 30, and it's 28, 29, something like that. So Markel has grown immensely, and it was a tiny little company, and we think, wow, we've really accomplished stuff, and we're a lot bigger. Well, we are a lot bigger, but still on the world stage, we're tiny. We're tiny. We have 2 people in India. I think we can have a lot more. So the world is a big world, and we got a lot of opportunity, and that's one of the places where we have an opportunity.
Yeah, and as Tom says, we think there's great opportunity in India. We recognize in India, in Asia, Singapore, you've got to be local, and you've got to have people who understand the local culture and know how to work in that culture and in those businesses. And we think it's an opportunity, but we also recognize you can't just run in there and punch the gas. It's a crawl, walk, run strategy in India. We're 1 to 2, so 100% growth in the first year. I'm very pleased with that. Singapore, we've probably got about 30 people. That office has been open quite a bit longer, and it's pretty settled now and growing nicely. So we will continue to look at Asia and continue to look to grow. The biggest thing we want to do is learn and be there and understand what's going on so that we can assess opportunities as they come up. The thing we want to make sure we don't lose sight of and lose focus on is there's still just tremendous opportunity for us in the U.S., in Europe, EU. The places we've done business in for decades, we've not even come close to, tapping out what the potential is there. So the balance is going to be making sure we are in these economies that are growing really nicely and are learning and ready to take advantage of opportunities as they come, but not get distracted because there is just tremendous opportunities in our established markets.
Yeah, I would suspect that the volume of business that we'll do in Indiana next year exceeds India at the moment, and probably the amount of additional business that we can write in Indiana is higher than India right now.
Yeah. Thank you.
Hi, my name's Ron Mass from Santa Monica, Almatas Capital. I had a question about the acquisition of Nephila and how you think about the retro insurance business. We had a 5-year period, a very benign 5-year period of losses from 2012 to 16, followed by 2 years of some of the worst, I think the worst 2-year rolling period in modern history for cat losses, and just how you think about the long-term attractiveness of the premiums that can be earned in that business.
Sure. So kind of 2 pieces to it. First, let's talk about Nephila. Nephila actually does not or writes very little retro. Nephila has continued to move upstream in terms of their business. And so Nephila today is really reinsurance and actually a growing percentage of insurance. So Nephila continues to move upstream in terms of the things that they are doing, and I'd be surprised, Barney, if you guys have any retro business today. Yeah, almost none. Catco was in the retro market, and that is a very, very different market. And as you said, it was very profitable when things don't happen and very unprofitable when things do happen. 2017 and 2018 were the costliest 2 years back-to-back in history, $240 billion, the number 1 largest cat year on record and the number 4 largest cat year on record back-to-back. So pretty brutal. You can make money in retro, and we will continue to write retro, but you have to recognize when you're writing retro, you're gonna, the volatility, the amplitude is gonna be immense, and you have to have the stomach for that. So we are gonna be writing retro and are writing retro in 19 and into 20. The pricing market, as you might expect, is very different after the last 2 years, and so pricing is considerably better. We are also able to, in addition to get additional price, reduce coverage because people need coverage. The way the markets work, as markets are softening, the prices go down, but even probably more importantly, the coverage expands. and that's usually where people get hurt worse, is the coverage expanding. We're now in the part of the cycle where prices are going up and coverage is shrinking. So it is a business we can make money in. It's a business we will stay in. It will only be of a certain size because of the volatility that it has.
And we have Barney Schauble here from Nephila with us, and I'll offer you the mic if you have something you'd like to add to Barney.
I'm happy to answer any other questions, but I think that's a good overview.
All right, the guy who knows what he's doing says we're in good shape. Thank you. Sir.
Carlos Sava from Chicago, Illinois. Congratulations on the Tesla and State National partnership. Probably going to be, billions of dollars a year over time. So my question is, maybe strategically and mechanically, how's that going to work in terms of a percentage seated, if they're going to be bundles, and two, how important was the data that you're going to be getting from Tesla in the underwriting process, or is it also a matter of size, so it could be replicated by another company like CarMax, which I know you're very familiar with? Thank you.
Sure. The way this came into the news was, I think some diligent reporter was out reviewing regulatory filings and realized that our State National team were providing the paper for this initiative. And we just want to be very respectful of Tesla and the other partners that are in this initiative, because we don't want to be seen to be taking all the limelight when really it is their program. The way we are participating, the way we're helping this happen is State National. I think a very simple way to think about State National is they provide the plumbing to move risk to capital. They provide the regulatory filings, the insurance paper, the behind-the-scenes administration, all the things you would need to get risk to capital. When you have these innovative products and people like Tesla, who really don't, as smart as they are, don't know the first thing about how to get an insurance policy written, they come to people like State National to help them with the execution of that. So Tesla obviously has this idea in terms of a program and what they want to do. State National will be the plumbing to move that risk to capital, and there is a capital provider sitting behind State National that will be taking the risk. So we are the plumbing in this equation. We are not taking risks today on the Tesla program. Is there anything you guys would want to say, Terry or Matt? They say I did a reasonable job of explaining that.
I have nothing.
Thank you.
I have nothing to add. Joe?
Hi, I'm Joe Dorison from Longmeadow, Mass. I told Tom about 20 minutes ago that I didn't think I had a question this year, but I've started thinking about it, and Warren Buffett made a lot of comments yesterday on stock buybacks and the ability of his company to put large amounts of capital in if he thought it made sense. And I guess my question would be, is that something that you're all thinking about as a possibility as well in the future?
Certainly. Thanks for the question. And yes, we have bought a bit of stock back recently. We did so last year, and our first quarter's been, the Q's been filed, so you can see that we've repurchased some shares during the first quarter as well. Again, if you look at our annual report the last several years, I don't know that I said it every year, but I've certainly said it several, there's a triage formula of how we make capital allocation decisions, and this is the pecking order. So the very first thing we would love to do with capital is to invest it in our existing businesses with our existing people who have proven themselves in some form or fashion, and they found something, they have a new idea, they have some ability to grow, and they've been part of the family for a while. That is the first place where capital gets allocated, is to something like that. Secondly, we have a history for 30-plus years of doing acquisitions. For a long time, those were largely concentrated in the insurance world, but now we've increasingly bought things that they're outside of the insurance world. So if you do sort of the Venn diagram of what we're willing to look at in terms of what our targets are, if we have one Venn diagram that says insurance and the other Venn diagram that says everything other than insurance, I think the whole world is our oyster. So that's step two of potential acquisitions. And importantly, all of those acquisitions were met with some degree of skepticism some way or another, including internally. And it's part of the healthy debate that we would have about somebody having an idea or somebody thinking that this ought to be done. I can assure you, long before Richie and I were in charge, when Tony and Steve would argue about what to do or not do, these were not unanimous, oh, that's a great idea, go ahead. There was process, trust me, about how that sort of thing was done. So there's not only a financial hurdle, but there's an intellectual hurdle within the organization to vet and fund acquisitions. So that's step number two. Step number three is we're active investors, both in publicly traded stocks as well as fixed income securities. So that's the next step. And then step number four is our own shares, that if we have more capital than we can appropriately or attractively deploy in those first three buckets, and our stock is attractively priced, well, then we should buy some of that back. And that's not just theory. That's something we've actually started to do over the last 15, 18 months, and count on us to try our best to be rational. And within that framework that I just described, which has been consistent for a long time, that's how we would think about it.
Thank you.
Nothing to ask. Good.
All right, thanks.
Hi. Hi, my name is Ryan, and I'm from Dallas, individual investor. Sorry if my question seems a little unpolished. So, are we allowed to ask two-part questions?
You're allowed to ask whatever you want.
Oh, okay.
We're loosey-goosey around here.
So the first one is related to ventures, right?
And if you could perhaps lean a bit closer, and you're a bit hard to hear.
Okay. The first question is related to ventures. With respect to like past and current model, has the model been more of Markel being on the lookout for good companies and same mentality shareholders, or have they been approaching Markel? If it's the former, how do we, is it a matter of size? How do we get to like Berkshire's reputation and goodwill? Maybe that will help us a lot in volatile times when we have more leverage to do the deals and stuff. The second question is with respect to investments. How has bringing in Saurabh has evolved? How has bringing in Fresh Mind evolved or changed the investment process?
Okay, so I think the questions are related to the ventures deal flow and deal process and the investment thought process. So let me take the first stab at those. So the way the ventures started was back in 2005. And again, this discussion dates back to 1990. When I joined Markel, Steve Markel and I talked about the Berkshire model and what Buffett had done, where he started with an insurance company which produced excess capital, and he took that excess capital and he invested in equity securities, which was unusual at the time. And then the next step on that path was, instead of buying just shares of company, to buy controlling interest in companies. That was the path, and continues to be. So Steve and I talked about this from day one when I joined the company. It was not until 2005, when the stars aligned and circumstances came to be, that there was an actionable idea where we could indeed pull the trigger and buy controlling interest in a non-insurance business, which was AMF Bakery Systems, and all kinds of reasons for why that came to be. But that is what came to be at that point in time. To the question about process, and did an investment banker show us that, or did we make calls, or did calls come in? What actually happened in that circumstance is the gentleman who was the CEO of the company at that time, and by the way, Ken Newsom, he is still the CEO of that company today, 15 years later, which I think is a very telling circumstance of the fact that he did what he said he would do, and we've done what we said we would do. Well, Ken is someone who I knew personally from around Richmond. And I saw him one day, and he looked despondent. And I said, just as a friend, I said, Ken, if I was playing poker against you, your face is, you're not holding good cards, man. What's up? So he told me that AMF Bakery, of which he was the CEO but not the controlling shareholder, was going to be sold. And Ken had worked in a private equity-backed venture before, and it did not end well. So he did not want to go through that again. So I said something like, oh, you know, I'm Markel, we might be interested in that. And he said, really, you do that sort of thing? I said, yeah, we'll do that sort of thing. So they had an investment banker they were starting to process. He had a big PowerPoint deck created and all this kind of stuff. And he wanted to show that to me. And I said, no, I'm an accountant. Jeremy's accountant, Richie's accountant. We all started as accountants. I said, let me just see the financial statements. And so I looked at 5 years worth of financial statements. And in about 30 seconds, I said, this is a good business with a bad balance sheet. The gross margins were fine. It was just over-levered. So I said, I understand that. And the idea of baking bread, the equipment that does that, that's been going on for thousands of years. They were market leader. I just didn't think that that was going to have any obsolescence. But long story short, we were able to get a deal done to buy AMF bakery equipment at that point in time. The very fact that we did that took the notion of Markel Ventures from a theory to reality. And frankly, our phone started to ring with other people who said, well, I didn't know you would do that, but I have this or I have that. Half of the deals that we have done in Markel Ventures have not had any intermediaries involved. It's been direct phone calls coming in, somebody saying, you know, will you talk to us? Will you take a look at our business? And that continues to be the case. So that's very good deal flow in that sense. And the way in which you build the reputation that Berkshire enjoys is, as Munger would say, you deserve the reputation. And in the passage of time and just consistently executing it year after year after year after year, the hockey stick of compounding takes place. And you know, while AMF was a $50 million business with $5 million worth of EBITDA at the time, you know, now we're looking at businesses that are significantly larger than what AMF was at the time as possible transactions. And by the way, AMF in a relatively low growth industry because of the internal growth and the quality way in which they've run their business, as well as doing a few adjacent bolt-ons in that industry. And that's a company that'll do $300 million-ish kind of revenues these days in a relatively low growth industry. So both the acquisitions and the organic growth continue to work very well. That process, that knowledge, that exposure to all these other businesses also helps Sarah, it helps Dan Gertner, it helps myself, the people who are involved in making equity decisions, to have information and flow and awareness of business in general that informs our decisions. The other thing that we have spectacularly benefited from over the years, and you've observed that many of the questioners are people who I know them by name before they say their name. These are people who own Markel stock, and they're rooting for us. And they're thoughtful, good, intelligent investment professionals. And frankly, they're my friends. I like them. So we talk, and I've learned so much from our investors and gotten very good ideas and flow. And it's not trading. It's not insider stuff. It's not any of that. It's long-term investment thinking that, again, creating and nurturing a unique group of shareholders is part and parcel of the process as to how this machine works in totality.
Hi, Matt Rappaport, Miami, Florida. In your pursuit to mimic Berkshire Hathaway, Warren mentioned yet again the difficulty of acquiring a large enterprise given the intense competition mainly from private equity. Given your smaller size, can you discuss how you successfully acquired Casa Farms and what you've learned from that large acquisition?
Well, thank you. I'm gonna slightly adjust the question because the mimic would not be exactly the word I would use. What we're trying to do is build a long-term, wonderful business. Now, it happens to be that Berkshire is a spectacular role model to look at. You know, I know we have standing room only, so I suspect somebody is leaning against a light switch. It's like that story about the preacher who was going a bit deaf, and they observed that, yeah, he conducted a 3-hour prayer meeting kneeling on the cat. So you might not know you're leaning against a light switch, but I suspect you are. So just wanted to clarify. You know, Berkshire is a spectacular role model. And we are unabashedly admirers of that, but mimicking is too thoughtless a word, so I just wanted to clarify that sense. Costa is a great story which illustrates exactly what's happening. So I think in the room today is Larry Cunningham. Larry, are you here somewhere? I know he was here earlier, and if you see him, again, thank him on behalf of Markel, fellow Markel shareholders. So Larry wrote a book, and Larry has been sort of the foremost Buffett scholar over the last 30 or 40 years. The original essays of Warren Buffett were compiled and edited by Larry, and his most the book before last was called Berkshire After Buffett. And he was laying out what he thought and his theory and hypothesis as to what would happen at Berkshire after it was no longer run on a day-to-day basis by Warren Buffett. And in the last chapter of the book, there was a discussion of, are there any other companies which seem to have the same mentality, the same mindset, the same thought process? And he was kind enough to write a page about Markel. And it was nicer than anything that I could have written myself, but it's independent third-party guy. Well, it just so happens that an advisor and a close associate of the Costa family read that book, saw that reference, and picked up the phone and called us and said, will you talk to us? I said, absolutely, we'll talk to you. So we engaged in a discussion, and it became immediately clear that there was spectacular value overlap between the way they think about their business and the way we think about our business and the quality of the business they have and the growth, double entendre opportunities that they have. Costa grows plants, for those of you who didn't pick up on that joke. But yes, it's a spectacular organization, and it came about through the prior gentleman's question about reputation and how that facilitates deal flow. That is true. And Richie and I both are beneficiaries of the Markel efforts that happened before we got there, and the acquisitions and the fair dealing and good practices that were just the hallmark of the organization. And we get to receive phone calls that we would not get from a standing start. So, and that process, as long as you continue to behave properly and do the right thing, it compounds and grows over time. And as Buffett says, it takes a lifetime to build a reputation and about 5 minutes to ruin it. We could ruin it very quickly. But we're long-term enough to know that would be a really stupid thing to do because, and Richie can opine on this as well, and I hope he will, the quality of the phone calls that we get these days are materially order of magnitude, and I use that word with precision because I'm married to an engineer, and having been lectured, I know what that means. They are order of magnitude different and better than what they were 10 and 15 years ago.
Yeah, no, absolutely. And just as an example, the State National deal, I think the dealings that we had and it was a very pleasant negotiation. I mean, we immediately knew we hit it off when we met each other, and then the only question was, could we get to a deal that could work for everybody? And that was a really pleasant process, which they are not always pleasant, I will tell you. I think that deal, working with the State National guys, directly led to the Nephila deal.
That's right.
And so that's the sorts of things that we have the benefit of now that maybe we didn't have 10, 20 years ago.
And just to add, before we get to the next question, so if you want some insight into process for how things work at Markel, what happens, and this is our policy and procedure, even if we don't have it written down, is if I get a phone call or if I become aware of something and it starts to become real, the first person who I talk to is Richie. And I just let him know in broad brush terms what I'm looking at and what I'm seeing, and vice versa. If he sees something and is exposed to something, the first person he talks to is me. And that's the way the process works. And I can remember, and I even remember the deal, I came into Richie and I said, well, I thought we were going to, I didn't know we could keep finding things, and I told him about what we were going to buy. And his comment was, someday you're going to run out of, I'll call it weird things to buy. He did not use the word weird, I'm covering for him here, but eclectic things to buy, shall we say. And amazingly enough, that was 4 or 5 deals ago. And again, it was a market-leading company who was #1 at what they do. And in fact, is Mark Hughes here by any chance? Mark, are you still here? He might have had a plane to catch. But after we announced that deal, my good friend Mark Hughes is a Markel shareholder and a great friend, called me up because we didn't disclose the terms or the finances of this particular business as we bought it, but he was a good enough sleuth and investigative reporter that he did some work and figured it out. So he picked up the phone and called me. He says, "Congratulations for buying another leading company in an industry that I did not know existed." So there you go. And I think to some degree, insurance-linked securities fits, and the State National, the notion that what you did was so under the radar. You probably didn't get a lot of traction at a cocktail party describing what you guys do, but we appreciated it, and we still do. Thank you.
Hello, good morning, and thank you for hosting this event. My name is Jesus from Spain. I have seen my question is related to one risk that you have raised in your 10K report. Sometimes you speak with some asset managers here in the US, and they are somehow afraid of investing outside the US. And for a foreign person that is currently living in US, it's some kind that I think that they are limiting themselves to this investment global availability, that are a lot of opportunities out there. So my question is, lately in Europe and also in my country, last month, we have seen that political parties are moving from more central positions to radical positions. There has been a lot of movement, despite of Brexit, which a lot of has been said, in France, in Italy, in Spain, and in Portugal. There has been a lot of movement in this political situation. My question is, how do you address these risks? Despite of being very cautious with the stock picking, how does Markel address this risk? Because from my opinion, it's great to see that you not only are investing outside, but also you are growing, as you said, in India. So it's great to see that, and congrats for this decision.
Well, thank you. I think in general, the notion of how do we address the risks of operating in markets outside the U.S., both from an investment point of view, from an insurance point of view, the correct answer to that is Richard's response: crawl, walk, run. So we recognize that we absolutely have to figure out and learn how to do business all around the world. We will do that in measured, one step at a time ways in which we find businesses, build relationships, have relationships of trust that work all around the world. I would add, for instance, in the early days of Markel International, and both Richie and Jeremy lived in London for a while at different points in the Markel International business, we wondered whether our ideas, whether our culture, whether our values, whether our thoughts about incentives would resonate in a different market than the U.S. It was a new thing for us. And we found out that in time they did. And the same things that mattered to us mattered to them. Not to everybody, and there was a sifting and sorting process, but the same principles of trying to serve your customer, trying to do something for them rather than to them, to provide a product or a service that they need and want, and you're helping them, you're making their life better by virtue of them doing business with you. That works everywhere. And we just need to figure out how to execute that and make that real. And the way you figure that out is you start small and you learn something, and then you do more of it the next day.
Yeah, and you're sort of touching on the social political risks there, and a great example is Brexit. I mean, we have 700 people working for Markel in the UK, roughly, about 700. Probably
in the UK.
And so that is a big operation for us. So we are very concerned with how Brexit ultimately shakes out. Well, we didn't sit and say, okay, we're just going to wait and see what happens. We got ourselves prepared. We started an insurance company in Germany. Frederick Wolf and his team now run that insurance company. We wanted to make sure no matter what happened in terms of Brexit, we were able to serve our customers. And after Brexit, if in fact it goes forward, European customers will have to be serviced by European insurance companies. So 2+ years ago, we started down the path to make sure we had a way to operate and serve our customers with no interruption, no matter which way Brexit went. And I think we do the same thing anywhere else where we're operating. We obviously have operations in Spain. That has been a crawl, walk, run process. And Spain has actually been a very good country for us in terms of the results. So we're aware of those things, and we try to make sure we're mitigating risk in those areas.
I might just add, I mean, there's always a lot of negativity in the headlines. Tom sometimes sort of speaks to that. But, you know, good businesses and good operations over a long period of time, that'll be the focus. So Europe's an incredibly mature insurance market and clearly an area where we wanted to have a solution, as Richie points to, with regards to Brexit, where it was all about continuity of our operations, certainty for our customers, and having a great solution in place. And an area where we continue to grow, and we kind of move from that phase where we're at right now with regards to kind of India, where it's about kind of learning, where we're certainly in that phase of really we're earning in that space. So I think that's something to consider as well. Thanks.
One other point, we did not start the German business in response to Brexit. We started the German business when we found Friedrich, long before Brexit got on the radar screen. So I think there's some serendipity about Markel that, again, just by being in the game, to be conducting business across a lot of different spectrums, a lot of different times, we just keep meeting people and getting to know people and being exposed to opportunities, and we're very open-minded. One gentleman that I met during the India trip this past fall was a spectacular executive, and it was one of the funnest moments of the trip. And I refer to it in the annual report letter. This is a guy who started from scratch and has built one of the world's leading supplier of automotive parts from nothing. And he does it all around the world. In India, in Asia, in the U.S. So it truly is a world-class operation that operates not just in behind the walls of a domestic market. And in hearing his story and feeling the energy of what he had done, he describes his company, among other things, as a not yet company. So if somebody says, do you do this, or do you do that, or what do you expose an opportunity? He says, well, I don't do it yet, not yet, but perhaps I should. Tell me more about it. And that open-minded learning structure was manifested in a building up of a multi-billion-dollar business from nothing there. And I hope that we have that same spirit about us, and the decades would indicate that to greater and lesser degrees we do, because very little that we're doing today we would have done 30 years ago. Thank you.
Thank you for your answer.
Thank you.
Good morning. My name is Jonathan. I'm from Dublin. I'm going to read the questions off my phone because all the cool people are doing that at Berkshire, so I'm going to pretend I'm one of those. The first question is, with less insurance underwriting risk, less net premium per dollar shareholder funds in 2005, I'm not sure what the various regulatory requirements are here for how much you can invest in what different asset classes, and given your excellent long-term investment track record, why are public equities not more than 80% or so, including ventures and so on? And the second question is, which is with the benefit of hindsight, but is relevant for potential future deals, how do you think about the way you financed the Altera deal?
I'm sorry, financed
the Altera deal 6 years ago.
Yeah, well, picking up on that, we did issue some shares to finance the Altera deal because the size of that transaction relative to the balance sheet at the time required some equity capital as part of it. The Altera deal has worked out wonderfully. In fact, I would say, and Richie and Jeremy would probably chime in, you know, for a long time, the insurance companies that we bought were not exactly the crown jewels of the insurance empire, shall we say, and many times they were troubled organizations. But the beautiful thing was, especially back at the beginning in '86 and '87 and '90 with the Shan deal, we didn't have a lot of money. So the only thing we could afford to buy were things that somebody really wanted to sell, and at a low price. And typically, that is not the best insurance company in the world. So we had a long history, and the market sort of understood a reputation where we would buy something of a troubled company and then expend blood, sweat, and tears to make it better. And that all worked. So we bought Shan, and there was a J curve where the results were challenged for a little while. We bought Terra Nova about a decade later, and that had a J curve where results were challenged for a while. And those were basically double the size of the company kind of transactions. And they, involved some equity raises in each of those. We bought other smaller companies along the way which were similarly troubled, but we were able to finance internally without issuing any equity at all. Now, when Altera came around, we told the market Altera is a good company, but the market was so used to us buying not so great companies that the Markel stock went down sort of as a reaction because the market was kind of saying, oh no, here they go again. They're taking on this problem. And now, 5, 7 years later, whatever it's been, Altera was a good company, and there haven't been any big blow-ups or painful aspects of that deal. In fact, many of the people of the Altera organization are leaders within Markel in total today. So we'll do both, and we'll try our best to say what we are doing in very public, open, transparent ways. And we hope now that the market has seen an example of us buying a good insurance company as well as some that have been troubled, that perhaps the market will believe us the next time, and I hope there will be a next time. Thanks.
Well, I might just actually add one thing to that. One of the things that's interesting, so we've done 5 fairly sizable acquisitions the last 2 years. So Brahmin, Nephila, State National, Surety, and Costa. And we financed all of those acquisitions. That's just under $3 billion. We financed all those acquisitions from cash resources on hand. So the Altera transaction is just under $3 billion for those 5. The Altera transaction was, I think, about $3.3 billion. And we had to finance that in part with equity. So again, having a larger company and having the cash generated from those operations has positioned us to acquire great businesses in the last couple of years, from cash resources on hand. Prior to the Nephila and Brahmin deals, I think our holding company sort of asset position was roughly $3.5 billion, and it sits at the end of the first quarter at, say, $2.7 billion. So that's that regeneration aspect of having cash flow operations, moving that capital up to the holding company, and then deploying that capital in wonderful businesses. That's a sort of a virtuous cycle that we're looking to repeat time over time.
Yeah, the only thing I'd say in terms of the use of stock in the Altera deal, I mean, we would always prefer to do just what Jeremy said. And thank you for mentioning that, Jeremy, because I was going to if you didn't. We'd always prefer to pay cash and not use the stock. When we were making the decisions around Altera, something that was very important to us is we were buying that company right around book, just a little bit in excess of book. And we felt really good from our due diligence that book value number was real. If you're out there trying to buy something that's a multiple of book, it could get really painful to use your currency, your stock. And so we don't like to use the stock if we don't have to. In that instance, it made sense to use the stock to be able to finish that acquisition.
Sure.
How's it going, guys? Bill Brewster from Chicago. First, just a quick compliment and comment on an intangible thing that I think may benefit some people in this room. Your hiring of Saurabh, I think, was brilliant. To the extent any of you don't know who he is, he put on investing talks at Google. To the extent any of the legends in this room participated, thank you. It's an incredible curation of investment content, and I think very forward-looking of you guys to include him in the organization. So hopefully someone in here benefits from that comment. I've spent a lot of this year listening to old Buffett stuff, and I was particularly interested in his comments on the Coke buybacks when the multiple was arguably a little insane. And his comment kept being like, I just want to own more of this company, right? It's going to keep growing. It's quality. I may not be buying it with my own money, but they can buy in the shares. So I was curious, to the extent that you think multiples are either durable here or not, how are you thinking through capital allocation in your portfolio companies, and how are you thinking about share repurchases seem to be the default, right? But I think an argument can be made for special dividends at some of these places. So just how do you think through that?
Well, thanks for the question, and you took the words right out of my mouth. The last thing you said is special dividends. So for instance, go through that triage that I spoke earlier of, we're going to fund things organically, then we're going to look at possible acquisitions, then we're going to look at publicly traded securities, then we'll look at our own stock. Well, let's play that out one more level. So say we did all those things and we still had money left over, but the stock was, in our opinion, not, I don't want to use the word overpriced, but not priced in a way that seemed that attractive to buy it in. Frankly, your word is exactly the right concept to have, is that if you did all that, you didn't have capital allocation opportunities, but you didn't want to commit yourself to a regular normal dividend, a special dividend is exactly the right rational act to take. For a lot of reasons, I think many of which tend to be in the realm of emotional rather than rational. Managements in general don't like to do those. They think they don't get credit for doing that. I'll commend again Progressive, which we've talked about and has been mentioned here and yesterday. Progressive does that. So again, there's an example of somebody who's thinking pretty rationally. Richie just reminded me, RLI, which has been a major shareholder, a shareholding of ours for a long time, does that. I think Nucor does that in the steel business from time to time. It's a pretty thin list of people who do that. More should do that than do. But if you consider yourself to be truly rational, that's exactly the fifth string on that particular instrument. Mike?
Hi there. Thank you, Jeremy, Tom, and Richie, for taking my question. My name is Joseph O'Beacon. I'm a student at the University of Mary Washington. I'm here with some of my other club members, and I really want to shout out to Rob Witt for inviting us, which is really, really cool. I am currently not a shareholder, but that's probably going to change within a few weeks after this meeting. I have a two-part question. In 2016 or 17, Tom, you wrote in the annual letter that you guys like to buy resilient companies. How do you guys identify resilient companies? And the second part is, with the AMF investment that you were talking about earlier, the bread company, you said you bought it at $50 million with 5 million EBT, give or take, which is 10%, which is kind of what Warren Buffett and Charlie Munger were talking about yesterday at the very beginning of the question and answer. And I wanted to hear some comments on that. Why is it 10%?
All right. Let me thank you for your question, and thank you for representing the Commonwealth of Virginia and schools. And I might add, since you brought up the Commonwealth of Virginia and schools, how about those Wahoos, huh? You know, so, yeah. I have to tease Richie about that because he's a Virginia Tech guy, so I had to make that point. One technical correction. AMF was doing $50 million of revenues at the time. On that $50 million of revenues, they've made about $5 million of EBITDA pre-tax profit. We paid far less than $50 million for it. So our sort of calculated rate of return would be meaningfully higher than 10% from the purchase price. The more important thing than the initial purchase price, although that's important, is the returns they've earned subsequently. So what capital have they dividend back to us? What capital have they retained in order to grow their business? And what sort of returns are we earning on that? Was it Einstein who said the compound interest formula is or no, it's Benjamin Franklin, excuse me. Money makes money, and the money makes more money. That compounding effect is that when you have the money that money made making more money, that's when the afterburners are kicking in, and that's the reinvestment, which is more driven by the operations of the business than the initial investment question. So with that technical clarification on the AMF numbers, the notion of a resilient company, so one of the guys I introduced earlier along the way was Andrew Kralik, who's on the Markel Ventures team with us, and Andrew worked for the Stevens Company in Little Rock, Arkansas at one point in his career. And he talked about, the way the Stevens family talks about their business is, the goal of this business is to be open for business tomorrow. And everything flows backwards from the statement. So if you want to be open for business tomorrow, what should you do today to ensure that outcome? Well, you shouldn't treat people badly. You shouldn't over-lever yourself. You shouldn't pollute streams in the air. You shouldn't behave in non-sustainable ways. You should be an entity in an organization that people are glad you exist, rather than one that they would dance on your grave if you were gone. You want to behave in such a way that people will miss you if you're not there. So really, a lot of what I would consider resilience can be described by those traits, where you look at a company, what they do, well, why? Why do they do that? Is that a good thing? Is that going to be a behavior that that society is going to want tomorrow or not? And I think that's a reasonably good filter and a reasonably good screen that would match up very well with that idea about resilience. Because, lots of times what people worry about are macroeconomic factors. What are interest rates going to do? What is the stock market going to do? What's going to happen with Brexit? What's going to happen with wars and rumors of war, so on and so forth? Well, all of those things will happen. And there will be bad days as well as good days. But if you, as a business, behave in such a way that the world really wants you to be in business tomorrow, you'll be resilient through those macro things over which you have no control. And by the way, all the people that you're competing against to try to still be there tomorrow, they will face the same factors and the same challenges as well. So as long as you're taking care of your customers, everything else will take care of itself.
I might just kind of add also, I think part of what makes a resilient company is curiosity. We flagged that kind of earlier, thinking about ILS and then leading into an acquisition in that space. But I think that's part of what you would find for very durable, long-standing organizations is they adapt, and they adapt through curiosity. I think that's an incredibly important part of what we think about when we look at different companies. Whether or not we actually do a deal, we learn from them, and I think that's really important.
Thank you.
Thank you very much.
Thank you.
Hi, Tom. Keith Stacy from Philadelphia. You mentioned early on that you were buying not the crown jewel insurance companies early on when you didn't have a lot of money, but then when you bought Alterra Insurance, you were buying a crown jewel. What's your experience with buying the not so good ones and making them good versus buying a good one right from scratch? Buffett always talks about buying a great company at a reasonable price is much better than buying average or poor company, quality company at a really, really cheap price.
Well, I'll start off and then I'll turn it over to Richie very quickly. By buying companies that were struggles, when we started doing that, Richie's hair wasn't gray and I had hair. So there's a challenge and there's a process, but why don't you take the first?
Yeah, I mean, you learn from everyone you do, right? And some learnings are more painful than others. And I would say in some of those early days, the Shan deal, the Terra Nova deal, there were some painful learnings there. But it's what counts is getting through it and making something of it, and making good on those deals. And I think by any measure, the Shan deal has been spectacular over time. The Terra Nova deal over time has been spectacular. So a big thing you learn when you're going through those is just perseverance and continuing to fight through and making sure you turn that business into something you'll be proud of. And honestly, I think the learnings from that helped us later identify good businesses. When we actually had the good fortune to actually be able to afford some really nice businesses at fair prices, it was a lot easier to identify them because we had fought through some pretty tough ones.
Mark Twain says, a man who picks up a cat by the tail will learn things about a cat that you can learn in no other way. So we've done that. And in the future, we will probably need to do some learning again. But what I want to stress is that, so for instance, it's not just the price you pay relative to the price that business could be worth if you fixed it right now, but what is the runway that business would have? So for instance, at the size and scale where we are right now, if there was a troubled company or a real turnaround opportunity or a real thing we could get in and fix, and if we fixed it, it was going to be just to make a stupid set of numbers, a business we made $1,000 a year on, we're not going to do it. That's too small to consume the time and energy and intellectual capacity that we have. I mean, there was a point at like the last guy from Mary Washington who was saving up $1,000 to buy a share of Markel. Well, I was a student. I remember when $1,000 was, it took some time to accumulate that grub stake of money. Well, fortunately, we're a little bit past that as Markel. But if you add some zeros to that, it may well be that we would take on the challenge of buying something that needed hands-on management because it would be worth a great deal after we finish. And the size and scale of that number has changed over the years. And what you and we should be rooting for is that would continue to be the case and that number would get bigger and bigger. And similarly, if there's a crown jewel that is available, and you have to pay for it, but it really is going to produce an acceptable rate of cash and good returns, but it won't really need that much work. Well, that's great too. We can do both. We'll go both ways, and that's just a spectrum and a balancing equation on both sides. Yeah. All right. I think we're over here.
Thank you. I'm Ashish. I've come from London. I've been a shareholder of Berkshire for a few years. I'm not a shareholder of Markel, so I'm the guy you had in mind when you started this. But I'm a few years late, so sorry about that.
We're glad you're here.
Thank you. I would also like to thank Saurabh, because Tom, I've known you, followed you on internet, but it was really Saurabh's tweet saying he's leaving Google to join you. And I thought, who does that? And I got more interested in Markel. So just wanted to thank him as well for the breakfast. My question to you is around understanding the downside on Markel, because Warren and Charlie have talked about the 100-year flood, and they have said that Berkshire will survive the 100-year flood, even though most of the insurance companies will fail. So I want to understand from you, how do you think about such extreme market dislocations and events which could bring down the entire industry down? What sort of thought process you have around holding minimum cash balances, because they have fluctuated a lot? You know, Warren has talked about a 20 billion number for Berkshire. Do you have some number in mind? And if you could throw some light around, how do you see downside events playing out for Markel? Thank you.
I'll take first.
Yeah, I'll take the first stab at that. And Warren sort of gets that. I think he gets that question every year. And yesterday, a very similar answer in that if you've got, you are someone who has catastrophe risk and you're looking to get that insured or lay that risk off, he would tell you that Berkshire is the only place you should go with that, or certainly the best place you should go with that, because they have built Berkshire to withstand any sort of event, and they very well may have. We obviously do not have the capital base of a Berkshire, and so, but we think about those things just like Warren and Charlie and Ajit and that team do as well. So, as a result, we only take so much cat risk on our balance sheet, and we constantly ask ourselves, well, what if we're wrong? What if we're wrong and it is multiples of what we think it is? Can we open for the next day, as we were talking about in a previous question, because that is the ultimate goal every day, to be able to say, yeah, we're open for business the next day. So we're not in the enviable position of Berkshire to be able to be sort of the market of last resort to place those big, hairy risks. But what we do is we make sure we take appropriate risk as it relates to our balance sheet, and we think very hard about what happens if we're badly wrong. We want to make sure there's a margin of safety there.
Yeah, and I would add, so we do think about this all the time. I was jotting down a quick list while I was thinking about things. So to give you some assurance that we do think about these things and we do proactively model. Since Richie and I have been at Markel, and Jeremy would be there for the bulk of this list, we have had Hurricane Andrew, the 1987 stock market crash, the 2000 transition from .com to .bomb, the 2008-2009 financial crisis, Katrina, Rita, Wilma, which were 2005, the Florida hurricanes of 2017, and the California wildfires of 2018. And each one of those stung, and you could see a bit of a mark, but nothing was fatal. And we were always resilient and able to open for business the next day with a more robust set of business opportunities than existed the day before. So in addition to the theory of modeling and playing out what if and looking at a variety of scenarios, which we do all of the time, you at least have a multi-decade record of us going through a number of things that challenged us, but we survived and learned and did better the next day. And that continues to be the case. The other point that Warren made yesterday, which I think was profound, and it certainly landed with me, was the notion that, okay, if you really push and stretch and keep iterating of what if, you would need too much capital to accept any risk. So therefore, what you have had happen at Berkshire is, by virtue of the pacing at which they've grown over the years, they've been able to grow the amount of risk they have because the capital has been growing at the same time, and it hasn't been completely trapped inside a traditional insurance company fixed income portfolio and balance sheet, and been able to buy equity securities and have those compound, and buy other businesses and have those compound, such that the total capital resources, the credibility that owning a lot of Coke stock or See's Candy or Precision Castparts or whatever gives to the totality, the aura, the sheen of Berkshire. Well, to some degree, we're running that exact same playbook. So we do have hundreds of millions of dollars coming in of cash flow that is not connected to our insurance business. But one of the fun things about being at Markel is the non-insurance things we're doing create opportunity and credibility and heft an opportunity for the insurance business. And the insurance business, by day-to-day execution of that, creates investable cash flow, which we use to our mutual benefit, and it is a multiplicative thing. And again, there are very few organizations that have that architecture and structure in place, where instead of isolating the streams and having them operate in a completely siloed one-off way, by joining these streams, you're not adding 1 and 1 and getting 2. You're multiplying 1.2 times 1.2, and you know any multiplicative process which is more than 1.0 creates a geometric value explosion, not just a linear mathematical one.
Sorry. Hi, Tom. Jason Leader from Houston. And my question was, in the past, you bought some troubled insurance businesses. Perhaps you might buy some in the future. How do you, especially on the casualty lines, how do you really evaluate the liabilities that they are what you think they are and not materially worse?
Very carefully. Anytime you're buying a balance sheet in insurance, you know, you have to be very, very careful. And so that is probably one of the areas we've gotten better at over the time from some of those early forays. I think we are much better at assessing risk around portfolios of business that we might take on in an acquisition. In the Altera deal, actually it ended up being significantly better than we would have estimated. So certainly progress from those early deals. But you know, I guess I'll go back to that statement of margin of safety. I mean, when you're buying a balance sheet and you're evaluating the reserves, particularly long tail reserves, casualty and so forth, you got to try to build in a margin of safety to your numbers. And of course, there's a friction between that and a price at which you can get a deal done. And then it comes down to discipline of, hey, I have to have this margin of safety, which means this is what I can pay. And that's why we only do one of probably, you know, every 100 deals that we look at on the insurance side. The friction between that need for the margin of safety and the price you can pay often won't get a deal closed.
Let me add a little color to that statement, and perhaps add some real-world dimension to how it is that we would actually look at a casualty insurer's book of business. Well, I'll tell you a story. So I can remember, I don't know if anybody else in this room would have the same memory. I remember the very first beer that I ever drank. And I won't tell you what age I was when I did so, but I will tell you, like probably many other people in this room, it was from my parents' refrigerator. And it was a Michelob, and I don't remember the old Michelob bottles that had that sort of lava lamp shape to them. I really wish they still made that, just because for nostalgia taste, I'd like to have one, but it doesn't exist. Well, I can remember drinking that beer because I thought it was a good idea to drink beer, not because I knew what beer tasted like or thought it tasted particularly good when I had it. But I will also confess to you that in my life, I've had subsequent beers since that, as recently as yesterday. And each beer that you drink actually informs your palate and your taste buds as to what you like and what you don't like. You create a frame of reference. So frankly, because of the size and scale of the company today, we're big enough that almost any insurance-based organization that you would look at, we probably write some of it. or we know it. We're not coming into this completely blind, having never tasted a beer before. We've had a lot of beers. You can look at what they're doing in reference to what you do. So same kind of policy. Here's what we charge for it. Here's what our terms and conditions were. Here's what our claims process was. So those people who do that for us, we put together SWAT teams whenever we're looking at a deal. So our people who are in this business are the people who help us look at it and evaluate deals. That's the technical answer to how we do things.
I don't think I can add to that. I like beer too.
I want a beer now.
Yeah. Hi, guys. Adam Mead from Derry, New Hampshire. You touched on this a little bit a moment ago, but Markel has, $5.2 billion of reinsurance recoverables on the balance sheet. And could you maybe just delve into how you evaluate the counterparty risk, prevent those assets from becoming what Charlie calls, good until reached for? And to what extent does that become an opportunity on the upside? How do you evaluate that as a spigot, if you will? Can you turn that off and take some more of the risk, and maybe just touch on that a little bit?
Yeah, sure. So I think the first thing in looking at our reinsurance recoverable balance is to start by understanding there's kind of two big parts to that. So one of them came as a result of our State National acquisition. So the more significant component part of that, and I don't have the number right in front of me, but it would be in excess, I think, $3 billion. Is that? Yeah. That's going to be associated with that program services business where we're fronting, and a significant portion of that is going to be collateralized. The remaining portion of that is going to be really with highly rated reinsurers. Then you have the more traditional reinsurance recoverable associated with our insurance and reinsurance operations, again, a portion of which is collateralized, and a portion of which is with, again, highly rated reinsurers. So I think that's part of the management there. From a credit risk standpoint, the State National team has managed that beautifully over a period of time. That's not to say that you couldn't get, credit risk is real. We get compensated, I think, fairly for sort of taking that credit risk on. It's not to say the risk doesn't exist, but it's very tightly governed and managed from a controls and oversight process. But that's something you will have noticed post that acquisition, how much of a more meaningful component part of our recoverables the program services side is.
Yeah.
Add to that, Rich?
Yeah, and I think the second part of your question, and actually I talked a little bit about this on the earnings call last week, is the opportunity to purchase less reinsurance and keep more of that business on the Markel balance sheet. And we are in the process of doing that over time. As the Markel balance sheet grows, we have more capabilities, more ability to take on more of the risk net. We are, as I said on the call, we are gross line underwriters, so we expect to make money on each policy we will, on the policies that we write in totality on a gross basis. Then that would mean our reinsurers are making money and we're making money net of that reinsurance. As we go forward, we're always going to, well, unless we become Berkshire, who does not need reinsurance, everybody else on earth needs reinsurance. So we will always, to some extent, need reinsurance partners. But as we grow and as we have the capability to take on more of that risk, we're going to keep more of it on our balance sheet. And that has been a process in particular that we've been working on for the last 2 years, where we've been moving from, we used to buy our reinsurance more at a product level. We're now starting to consolidate that and buy reinsurance more at an enterprise level. And you can imagine, it's just more efficient to buy at an enterprise level than potentially buying for each product with very different needs in terms of reinsurance. So I would expect as we go through 2019, the retention ratio for Markel of our gross written premium to net what we keep at Markel, that is going to increase. And in fact, Jeremy, would it increase a couple points in the first quarter?
Yeah, our retention was 87 versus 84.
Yeah. So that is a process we're going to continue because we believe in our underwriting and we want to keep as much of it as is reasonably possible.
Right. And let me add, in addition to what Jeremy and Richie said from a quantitative point of view, there's a couple of qualitative factors that are involved here as well. And these are really important. So Richie made this statement that we're a gross line underwriter, not a net line. And you can have different theories of the way you conduct an insurance business. And it's a legitimate theory to say, well, we're going to write some insurance because we know we can get good reinsurance behind it. We've never really bought into that. We want to write insurance that we think everybody, both the primary insurer and the reinsurer, are going to make money. And part of the reason for doing that is, all right, if you're buying reinsurance from somebody who you think is underpricing that risk, what you're doing is you're dealing with a spectrum where you want to buy reinsurance from somebody who's dumb enough to sell it to you at too low a price, but not so dumb that they're bankrupt when it comes time for you to collect the claim. And it's difficult.
It's hard to calibrate.
You are skating on thin ice when you engage in that sort of transaction. So pretty much as a matter of just policy and principle, we don't do that. We want to participate in transactions where the reinsurer makes money. In addition to the creditworthiness that comes from that, think about the California wildfires or the Florida earthquakes. Okay, so we're going to come around, and there's 10 different insurance companies that are at the primary level and selling policies and issuing claim checks, and they turn around and say, okay, Mr. Reinsurer, we need some of that reinsurance we bought from you. Who do you think the reinsurer pays first, and who do you think they pay last? Just which phone call do they take first? They take the phone call from the person who, over time, has produced profitable reinsurance business for them. There is an attitude of partnership that needs to take place, that is part of the way we do business, and it's part of the risk management tool. State National, also in many of their transactions, the position of just being first in line is an immense strategic value in the way transactions would flow. And then the last part, and it's a technical insurance word, but yes, we'll go both ways in terms of buying or selling reinsurance. And even with existing reinsurance arrangements, sometimes you could do what's known as a commutation, where you offer the reinsurer some price to just say, okay, let's end this and settle all that out now, rather than waiting for 5 or 10 or 15 years to do. And we would do the analysis and make some informed judgment as to where we think that makes sense for us to do or not. And it's another way in which we can increase the value of the flow of the business that we have. Thanks.
Hi, I'm Gil Kimmel from Vancouver, and we're Markel shareholders. And just 2 quick questions related to the investment portfolio. And if I understand, and I could be wrong on this, it looks like there's more than 100 holdings. And I know that some of the big ones make up a big percentage, but I'm just wondering if it's going to be tough to beat the S&P 500 with such diversification, because even if the small ones double, it may not have much of an impact. And then my second question, and I'm not sure if you can comment on this, but I'm just wondering what you thought about Disney's approach to try to compete with Netflix. And I'm just going to sit down to listen. Thanks.
All right. 2 questions. One, just the number of holdings that we have. You're correct in that the top 20 holdings represent probably 2/3 of the value of the portfolio. So frankly, it is more concentrated than what you would say, and I would do a dollar-weighted calculation of that rather than number of names. So that matters. There's also times when, for instance, since I confessed to you my beer drinking, well, I also like whiskey, and we're a Diageo shareholder, but we're also a Pernod Ricard shareholder. We also have Anheuser-Busch historically, and other companies that are in that. So if I own Diageo and Pernod and Anheuser-Busch, is that 3 holdings? Is that 1 holding? Is it 1.7? Is it 2.4? I don't know. It's not 1 and it's not 3. It's somewhere between that. So frankly, when you look at businesses that have some similarity to them and would be exposed to the same sort of factors, the portfolio is much more concentrated than what it would appear at first glance. Now, the reason I like to have a bunch of names, and my great teacher, Chuck Ockrey, wears me out about it all the time, you're not the first person to have asked me this question, is for me personally, owning a little bit of something makes me think about it more than I would if I don't own any of it. So you as fellow Markel shareholders have basically sponsored a membership in the library for me. So I just see stuff and I pay attention to stuff that I wouldn't otherwise if we didn't own some of it. But those holdings in and of themselves will not affect the returns, good or bad, either way, in and of themselves. But where they might affect is I might learn something by having been exposed to that does matter in the big holdings. So that's mechanically why that works. And then the last question you had about Disney and Netflix. We are long-term Disney shareholders. We don't own Netflix. I'm not breaking any news here. Anybody who looks at our filing would see that. And we continue to be Disney shareholders. I think it's an amazing organization that has reinvented itself and adapted over the years in a lot of different epochs and eras and different things in which they made money, and other, I mean, we use the term three engines of Markel, which drive results. If you look at the engines which have driven Disney's results over 50 years, they have not always been the same engine, but somehow or another, they always come up with one way or another. Thank you.
Good morning, and thanks for hosting this event. It's my second time here, and I come from Paris, France. I had a question regarding the Markel Ventures approach. How do you think about monitoring the portfolio companies and incentivizing the CEOs? What are the type of qualitative and quantitative things you look at, and with what frequency?
Right.
Thanks.
Okay, question is on monitoring the Markel Ventures companies at a company-by-company level and the incentive compensation systems that we have. I'm extraordinarily well served by Mike Heaton, who is the president of Markel Ventures. So from the Markel Corporation holding company point of view, he really is at the point of the day-to-day relationships with the CEOs who run each of those businesses. While each of those businesses would have a unique history, a unique story, and a unique way that they did things, they would have never become part of the family if there wasn't a great deal of cultural overlap and similarity in thought process for how people can and should be paid. And the hallmarks for the way we do things at Markel, and have for years and years, is we want it to be long-term, so not year by year, but long-term, so that it really reflects the ownership of the business itself. And we want it to be logical and related to the underlying profitability of the business itself. So we want people to have a piece of the action, but that action is measured by the cash results that the business produces and the cash results that the business over multiple years. Mike and Beth and Andrew, they're the ones who deal with the exactitude of each company. But philosophically, that describes each and every one of them as well as at Markel.
Thank you.
Thanks.
Good morning, Jeremy, Tom, and Richie. Thank you for hosting this event over here. I'm Kunal from Mumbai, India. And I came across Tom's video on Google Talk, and that's what, it was very educational, and that's what led me to investigate more on Markel. And I'm really excited. It's kind of following a Berkshire model of, taking, not being extremely risky, but still looking for return. So I have two broad questions. One was, if considering your thought process is very similar to the Berkshire Hathaway, the business model is similar to that. If Berkshire Hathaway tomorrow were to make a decent offer to Markel at a reasonable price, will that be something you cannot refuse, and why? And if you do happen to refuse, what would be the reason? Because Berkshire Hathaway, you mentioned there are, you're capital constrained as compared to Berkshire, and there is also reinsurance risk that you still hold. Being part of the Berkshire family almost will eliminate both of the risk and give you a lot of leverage in terms of capital. My second question is, I'm excited that you're venturing. One thing you're doing a little bit different from Berkshire is, you're going outside of the American, the home country bias. There was a question yesterday about, Berkshire having foot on the foreign soil. Is this something Markel has? Like, do you have some foot on foreign soil in terms of particular region or particular country to help you assess the demographics over there, the consumer patterns? How are you approaching that? Because venturing into different countries, as Warren mentioned, it is really difficult because something like a See's Candies cannot travel from West Coast to East Coast. So there is a strong challenge there. Those are my two broad questions.
Yeah. Indeed. So on that last point, both Jeremy and Richie have lived overseas and been at the head of our international business. So we are well aware of that, and they can add to that. On the first point about Berkshire, they know who we are, and we would not answer a call if somebody wanted to talk about these. But we're really building this business forever. And I think, we have no interest in selling the company. We would like to build it. We think we have been honorable stewards of capital that was entrusted to us, and equally importantly, the values, the system, creating an opportunity for people to be their best. That's part of the Markel style, the written document that describes our mission statement. When Richie and I joined Markel, we had roughly 350 people at that time. We now have over 17,000. I think that the world is glad that we exist and we serve people well and we provide good products and services. And I think the world is better served by us continuing to do that within the construct of Markel. And as long as we continue to do that and we do that reasonably well, the stock price is probably priced in a way that recognizes that and makes it such that it would not be a bargain purchase for somebody to buy. And that's a win-win circumstance and good, because Berkshire's able to do what they do and we do what we do. And both parties are able to do that well without that being a matter of interference to either one.
The only thing I'd add to that is, as we see areas in the world that we think are interesting in terms of our potential to grow there, it's critical that we have people that are local and know that society, know that community. And so we will identify areas that we think are potential opportunities for Markel. But, Singapore, India, China, the only way we then pursue those opportunities is with local talent. And then again, I hate to keep saying it, crawl, walk, run. We're not going to go and plop 500 people in China on day one. We're going to start out, get to know it, and add as we believe the opportunity is there.
Hi, Tom. I'm JP Bouchard from Montreal, and I have a question pertaining one of your biggest position in the portfolio, CarMax. So I would be glad if you could share your thought on the competitive position of CarMax and Carvana as a threat, please.
Well, the question is on CarMax, and I think it's part of the tradition that there was a question about CarMax at this meeting.
From Richmond.
In fact, for many of you who were there a couple of years ago, I invited Austin Ligon, who was the founding CEO of CarMax, and he happened to be in the audience, and he happened to be sitting on the front row, and he was just there, here as my guest, and all of a sudden somebody asked the traditional CarMax question, and I said, well, hey, Austin, why don't you answer that? And he professed to have a lot of fun, and he was grateful to do that. I will tell you that I invited Austin again this year, and he did decline the invitation. So if any of you know Austin, say, you chicken, you ducked out, and just tease him about that. CarMax continues to produce excellent results, and they have done so through thick and thin. It tends to be a stock we get asked about a lot because there's always something you can say as to why it's not going to work. You're concerned about the credit quality. You're concerned about the glut of new cars. You're concerned about used car pricing. You're concerned about Carvana, other ways, Car Trader, what have you. So sort of just like the rest of our business, there are always competitive threats to everything we do. There's nothing we do by ourselves that we have all to ourselves. Nothing, everything. So that's the case there. There continue to be competitors that show up. We're familiar with Carvana and what they do. I would just say that CarMax continues to perform reasonably well. I would say they have been excellent stewards of capital. Look at the share repurchasing they are doing and the degree to which they've shrunk the market cap of that stock. So compensating perhaps for some pressures in the business, the fact that you're dividing that pie by fewer and fewer shares creates wonderful returns for us as shareholders. I can assure you that the moment and the day that we sort of started accumulating and buying CarMax, it did go down for a while, and we kept buying it because we kept believing in it. And there are certain shares of CarMax which are now worth more than 100 times what we paid for it. It's a 100-bagger. So they get the benefit of the doubt with me for 100 Baker. I would also add that from a tax point of view, we're a full taxpayer. So if I was going to sell that and put it in something else, that something else would have to be better by not just what I received from selling the CarMax shares, but from the net after-tax proceeds. And if you, again, as Munger says, make decisions by the method of opportunity cost, the opportunity cost is different in reality than what it would appear at first on paper. So we're still very happy with that holding. That's a good one, sir.
Tom, Richie, Jeremy, good morning, and thank you very much for having this meeting and having this opportunity to ask questions to you. I have a quote: in a room filled with people with little knowledge, I'm someone with the least knowledge. So with that, first of all, Tom, thank you very much for educating the world about investments and business through your talks at Google as well as YouTube videos. That is wonderful. Thank you, Saurabh Madan, for building this platform at Google. You are creating enormous goodwill around the world by this initiative. Thank you very much. So I have two questions. What advice would you give for young men and women who are allocating their personal funds when they find opportunities to invest in companies that can become 10 baggers, 20 baggers over their lifetime? What percentages of their current net assets should they be allocating to such an opportunity? This goes back in time when you were a young person who came to Omaha to listen to Berkshire at that time, 29 years ago. If you found that opportunity, what percentage will you allocate there? The second question is more fun. You can't pick Warren Buffett for this answer. Apart from Warren Buffett, which other leader from the past or present, business leader, political leader, would you love to have lunch with, and and why?
Well, thank you, and I'm going to give you a bizarre answer to the second question. The first question, I think as a young person, if you find something that you think can be a life-changing investment, what percentage of your capital should you allocate to it? Well, a lot. I think probably less than 100%, because you should have some humility. You don't know. You do not know. And as someone said, if you don't know exactly the right word to use, you should have the humility to admit that. So a lot in a meaningful amount, and that really can change your life. In terms of a business leader that I would like to have lunch with, has anybody ever heard of Byron Smith? I thought that might be the answer. I think I would like to have lunch with Byron Smith. And let me tell you who Byron Smith was. So there is a company of which we are shareholders and have been for a long time called Illinois Tool. And Byron Smith, I think he lived in the 1870s or so and went to work for what became the Northern Trust Bank. And he did really well. And the Northern Trust still exists today. And he was sort of the patriarch of the Smith family in Chicago. And in 19-something or other, 02, 07, whatever, he put an ad in the Economist magazine, and he said, we would like to provide capital to high-class manufacturing businesses, preferably in the Chicago area. That was the ad. Well, somebody responded to that ad with a machine tool business, and that company became the Illinois Tool Works. And it's been around for more than 100 years at this point. Now, looking at Bloomberg, and I'm not a Bloomberg wizard, I can only go back to 1984, but the compound annual rate of return that you have earned as an Illinois Toolworks shareholder since 1984, which is as far back as I could get the TRA function to go, is about 15%. They've compounded money at 15%, for 40-some years, and probably at a pretty good rate before that. Now, I will also venture, just as nobody sort of knew who Byron Smith was, I would also go so far as to say probably nobody is able to enthrall a member of the opposite sex at a cocktail party with discussions about Illinois Tool. It just doesn't work. It's boring. But it's spectacular. It's fabulous. And that's what we're trying to do, both through these obscure and niche insurance businesses and these obscure and niche industrial manufacturing and service businesses. So in terms of a guy who had a vision and had a plan and just sort of laid himself out there and tried to build something, I mean, there's a lot of traditional cliche answers you could give to that question, but this might be a little different than that, and that would be the guy who I'd want to sit down and have lunch with. All right,
Fantastic. Thank you.
All right, we're closing in on the end. We'll get a last question or two, and then we know people have flights, but your question.
I'm Erica Heifetz-Mendelson. I'm here from California, and I apologize because I'm not a shareholder yet.
You remember we talked about that not yet company.
Right, but I'm going to give you the opportunity to change my mind. Because I'm here for Berkshire Hathaway, and we were on our way to the Borsheim's event where, when I was here before, I got to play ping pong with the, Asian ping pong champion, and I won a point off of her, and I think she just gave it to me. But anyway, but we got intrigued by this. And I have to apologize first because this may be an uncomfortable question for you. I was speaking with a gentleman this morning who runs a multi-billion-dollar investment fund, international. And we were talking about this company, and he told us, now's not the time to invest. They've had a lot of trouble. So I'm sure I'm not alone in this, and I'm sure there are other people that might be curious. So what would you tell somebody like me or him as to why I should invest now?
Right. Well, I wouldn't run away from the fact that we've had challenges. We've talked about that. The nature of the firm over a long period of time is that we've always had challenges. I did a presentation for our board a year or two ago. Richie was in the room at the time, and I actually brought a suitcase full of cash to illustrate the point. And I went down to the bank and I got a couple $1,000s of $1 bills to tell the story and make the presentation. So I opened up the suitcase and I got the wrapper there and I put down $8 of cash. And that's what Markel stock was when it went public. And I got some news headlines, what was going on in the world of that at that time. And then I said, so that was at that point, and then by 1988, 9 or whatever, it had gone from 8 to 16, it had doubled. And sort of described the news events in the negative headlines. And by the way, all news headlines are negative. They do not write. They are. You don't have a headline about the house that didn't burn, or it doesn't happen. And the old joke about the New York Times is that had they been at the Sea of Galilee, the headline would have been, Jesus can't swim. So it's negative. But I went through that presentation and I just whipped out the 8, the 16 with the stories between that. And then from 16 to 32, and 32 to 64, and 64 to 128, and 128 to 256, and 256 to 512, sort of laying out the cash all along the way to build the mountain there, 512 to 1,024, and we crossed that. And each and every time we crossed that, we went backwards almost by half before we got to the next threshold. It's just the way life works. It doesn't happen in a straight line. So I have no idea about timing. I have no idea about what the world's going to be. I have no idea about interest rates or the stock market or Brexit. I got none. But I can assure you that Jeremy and Richie and all the people you met from Markel and all the people all around Markel are working hard every day to try to do things of value for people, and in so doing, create value for Markel. And that's as close as I can get on timing. We will do the best we can.
Thank you.
With that, thank you, and we'll see you. Thanks.